All right, good morning, everybody. Happy Friday. Hope everyone is doing well and staying healthy during this challenging time. I know COVID cases have been on the rise, so we're going to be hitting on just some reminders from the CARES Act and everything that came with that to help you guys out. But as you guys are aware, this has been a pretty crazy year. The tax law that came in effect back in 2017 is still intact. However, there's been a lot of changes with stimulus packages that came out this year. So we thought it would be really helpful just to kind of recap the current tax law and then also hit on everything that came with the CARES Act. And then also what could be potentially down the pipeline as well with round 4 of the stimulus. So good morning again. I'm Clint Weeder and I got Andrew Steffensmeier with me. We're going to try to hit on all those topics here, and then feel free as we're going along. We're going to be watching the questions box. So if you have any questions throughout, just ping us or we'll get to them at the end as well.
Good deal.
So all right, this is just a quick little agenda that we pulled together. We're going to kind of hold to this, and like I said, if you have questions, we can hit them throughout, or then also a Q&A at the end. But hit on individual tax planning, retirement planning, business tax planning, and like I said, hit on the COVID-19 legislation that's hit us this year, including the CARES Act and the PPP, and then just briefly hit on what we think may be coming down the pipeline with round 4 of the stimulus. So with that, I'll kick it over to you, Andrew.
All right, good morning, everybody. Like Clint said, Andrew Steffensmeier here. We're actually just an office apart here, so coming to you on a Friday morning. It's a little chilly out, so glad everybody could join us here. So I'm going to take us through quite a bit of individual tax planning as well as a few things we can do on the business side. So yeah, as you can see on our screen, the slides will be at the bottom, and then we will be kind of looking over the questions as they come in. So feel free to, interrupt us, shoot out a question whenever you have those. So first off, we're going to start with those individual tax brackets. So as you can see on your screen, these are the same rates or the same tax brackets that have been in effect since the Trump tax cuts happened in 17, like Clint said. So just to compare and contrast, the rates used to be higher. So we used to be on a scale of 10, 15%, 25%, and on down. So these are the lowest rates that we have seen in the, in the entire tax history. So, we are looking, we're having clients come in with a little bit higher income this year with, potentially PPP being taxable. So, it might be one of those years where we want to max out some of these higher brackets if we expect tax rates to increase in the future. So that's one thing to keep in mind here. So kind of keep your eye on that 24% bracket. If you're married filing joint, that kind of ends at 326,000. So might be potentially one of those things we want to keep in mind this year. Want to keep going there. So again, kind of on that same tax bracket scale. So these are the dividend and capital gains rates. So, the federal government says if you have capital gains, they're going to give you a preferential treatment compared to those individual income tax brackets. So really want to kind of focus on the 0% row. So if you're married filing joint and your income, outside of capital gains plus capital gains is 80,000 or below, any long-term capital gains you have are taxed at 0%. So that can be a really powerful thing for folks to keep in mind if you have unrealized gains in some investment accounts or any other capital gain income. And then, of course, capital gains are always capped at 20% under the current regime. So there's rumblings about capital gains rates going up with administrations in the future. So we'll kind of see how that goes. Nobody knows anything, but we'll kind of bring those points to you. So kind of keep going there. So standard deductions, again, this isn't anything new. These are indexed a little bit every year for inflation. So they go up by about $200 a year. So back when the Trump tax cuts happened, that standard deduction for a married couple was right at $24,000. So for 2020, we're sitting at about 24,800. So not much change there, but we do want to kind of hammer home the fact that a lot of folks are not, they're finding out that they can't itemize anymore. So really Your itemized deductions are, your mortgage interest, any kind of state or real estate taxes, and then donations are pretty much the three buckets that we see clients filling up to be able to itemize. So we'll kind of see in a few slides here. Yeah, here we go. There are certain limitations on each of those three buckets that go into your itemized deduction. So the biggest one that has had probably the most negative impact is state and local taxes being capped at $10,000. So, for most of our clients, real estate taxes and then any kind of state of Nebraska income tax is the main one, and then personal property tax on vehicles. That bucket is capped at 10,000 of that 24,000. So really, for a standard client, if we're maxing out the tax portion at 10,000 and say our mortgage interest is 10,000, we kind of estimate that, you have to have donations of about 5,000 to 6,000 personally in order to even itemize with a dollar's worth more than the itemized deduction that the IRS is going to allow you. So yeah, it's just becoming a little bit harder to itemize. There's a few changes to itemized deductions here that are not ones we talked about. So any mortgage debt over 750,000 is now kind of phased out. So if you have a home loan for $1 million, part of your interest is going to be backed off, or you can't use it. Athletic tickets, I know that's a big thing this year with no fans at the Husker game. So yeah, we can't deduct the charitable contribution portion of the athletic tickets. And then, one other one to hit on is the casualty loss. So in the past, if you had a flooded basement or whatever, you could deduct a casualty loss if you had some unreimbursed losses. So under the current law, they kind of did away with those unless you're in a disaster zone. So any kind of the flooding that we had last year was a disaster zone. So just a few more limitations on there. Keep going there. So again, these state and local tax, that's kind of what we hit on with that maximum amount to be deducted at 10,000. So, here in Nebraska, it's not a super high tax state, but folks out in California, New York is really hitting them a lot harder than it is here, but it's still a factor. So yeah, there's not a whole lot here. We kind of hit on that already. I should point out state taxes, like real estate taxes, if you have rental properties, those taxes are deducted on Schedule E, like a rental schedule. So there is no $10,000 cap if it's rental property or business. So these are only taxes on your personal house. So we should make that distinction there. So extended tax provisions, these are, they passed the law, then they said, we forgot to put these in there, so let's shove them in there on the back end. So these are things that, have been pushed into law that were not part of the original law. So, you see here, a lot of the ones that we see are mortgage insurance premiums. So if you bought a house and you didn't have 20% down, you have that PMI insurance. So that is deductible on Schedule A for the most part, but, it's not a huge issue. They did, extend some of those energy tax credits. So, whether it's geothermal or solar, those do still apply, and they are kind of scaled down as these years go on until these tax cuts are set to sunset. So let us know if you have any of those, because they are pretty lucrative credits if we get them, in 2020. So, and then lastly, medical expenses is another portion of your itemized deductions. Again, we don't see a lot of folks itemizing with medical deductions unless we have a bad year medically, which we don't like to see, but so there's just an additional limitation that we could take a look at for you. Kind of hit on the right there. So yeah, we've had just a few tax planning clients come through so far, and if you are in the camp where you had a really good year and then you had some PPP loan come in, we're just not sure if that's taxable yet. So Clint will hit on that a little bit here in a few slides. So if we do have higher income, we want to look at these retirement accounts and where we can really have some good retirement deductions this year. So this slide kind of walks through some of our limitation amounts. So 401ks, we can defer 19,500, and if you're over 50, we can get all the way up to that 26,000 number. So those are important limits to hit, and then we can also do some profit sharing inside of a 401k if we're trying to get our income down this year. And then again, IRAs and Roth IRAs, we've been stressing to our clients these past couple years with the tax brackets coming down to the lowest historical rates. It is a good time to get money into those Roth accounts. We'd rather have you pay tax at these lowest rates that we've seen compared to what the future might bring. We assume that might go up, but again, we're just not sure yet. It's kind of the theme of 2020. Nobody knows what's happening, and so we're just trying to make sure we lay out all our possible options here. And then that bottom bullet item, Roth conversions. So if you have money in traditional IRAs currently, if tax rates are low and we expect them to be higher in the future, obviously we want to, if our tax situation allows, if we can convert those traditional accounts into Roth accounts, bring in some income at lower rates, just so in the future we don't have to pay tax when we're taking that money out of traditional accounts. So another caveat too, back in March and April when the market was kind of in the dumps a little bit, if we could do a Roth conversion at that time, obviously we have lower income, or the funds that we're holding are at a lower price. So if we can convert in those dips in the market, that's obviously best case scenario. Get the money in Roth accounts and enjoy that tax-free growth. Go ahead, Clint.
Yeah, absolutely. I just want to hit on that just a few more times. With if your income is lower this year, it'd be a good time to maybe take a good look at that Roth conversion to get those converted over. Another key point, back in December of 2019, the Secure Act came out. With that was a couple changes. One, they increased the RMD age up to 72. It was 70 and a half, but the bigger thing was with traditional IRAs, that stretch IRA pretty much went away. And so what that means is if you're going to pass it on to the next generation, they have 10 years to withdraw that IRA balance in those traditional IRAs, which could be a substantial tax burden down the road, versus if you have it in that Roth bucket, you don't have to worry about that issue. So it's another big reason, if you can, start thinking about those Roth conversions, and if it makes sense to do so, especially if income's down and with the current lower tax rate environment, something definitely to consider.
Yep.
And then I'll go ahead and hit on that with the state and gift taxes. There's a lot that could potentially change here under a new administration if a new tax bill were to get through, because there has been a lot of talk on this. But currently for 2020, the state tax exemption and gift tax exemption is $11.58 million per individual. So married couple, it's double that. So that's a pretty big exemption. So if you're thinking about gifting or doing anything now, especially if there's an administration change, it's something to take a look at. The normal gift tax annual exclusions remain at $15,000. So all that means is if you gift any individual $15,000 or less, you don't have to file a gift tax return. If you do a gift over that, there is a gift tax return filing requirement that's required, but there's usually no tax due unless you go over those annual or those total tax exemptions above the 11.58 million. It's just an informational return that gets filed with the IRS. So just something to think about with estate planning. And then there's been a couple other changes proposed with basis step up going away potentially. So there's just been a lot of different things in the mix. So if it's been a while since you've revisited your estate planning or your plan, it might be a good year to kind of take a look at that.
So education tax benefits, really, these have been in the law for a long time. So these are nothing new, but, like to bring it to light. So just a few education credits if you have kids in school, in college, or if you're, going back to school, whatever the case might be. Here's a few different options for you. The American Opportunity Credit is our most popular. So that's for the first 4 years of undergrad. parents, whoever's claiming the child who's going to college, can get that $2,500 per year for 4 years. Lifetime learning credit's a little bit less popular, but it's still available, you know, if you're doing a master's program or something past your first 4 years. And then 529 plans. So, you know, those are becoming a little bit more popular here in Nebraska. There were some changes with the tax law, but those really don't have too much of an impact here in Nebraska since it is a state issue. So we can, you know, currently in Nebraska, we can deduct $10,000 per year for, you know, if you're going to put some money into a 529 plan for a child or maybe a grandchild. So. Yeah, again, this is more along the lines of our business planning, or, you know, if you're self-employed, you know, if we have any, you know, depreciable assets that we're trying to depreciate this year, you know, if we have high income and we're trying to get below a certain threshold, there were some, you know, favorable depreciation changes that we should talk about. So bonus depreciation, you know, we have the ability to write off 100% of that asset's cost in the first year. And one of the biggest changes was, you know, qualified improvement property that happened with the CARES Act. So this was kind of a mistake that was made when they first passed the tax law back when Trump passed this tax law. You know, it basically said, you know, we can depreciate improvements for a, you know, structure that was already put in place, that was already built, and then you improved upon it. So we can now bonus depreciate all those improvements. So, you know, if you think that might be a scenario that you'd like to, you know, pursue, we can look into that. It's a pretty lucrative deal if you have pretty high income this year. And then lastly, that expansion for certain real property. So in the past, HVAC and any kind of, you know, roofing repair, if you're going to replace a roof, you know, we had to depreciate that over a long class life, or, you know, 39 years typically. So now we can actually deduct that all in 1 year. So, you know, if those are things that you think you might need to do in 2020, you know, we should explore those to get our income down. Yeah, so this is a, you know, again, we're trying to hit on, you know, the IRS came out with, I think this is part of the CARES Act, if I'm not mistaken, Clint. So, you know, there are a few credits that we can get if you have a new simple IRA plan inside your business, or if you start up a SET plan or a 401k plan. So how it works is if you set up these new plans for 2020 and beyond, you know, we can get a $500 credit for the first 3 years of the plan. So that's $1,500 tax credit to the business owner. And then if you have an auto enrollment feature, meaning everyone who's eligible is you know, required to enter the plan, we can have another $500 credit for the first 3 years. So overall, you know, that's about a $1,000 tax credit for the first 3 years. So, you know, the IRS is incentivizing these savings plans for employees. So, you know, if in the past you were, you know, not 100% sure you wanted to do a simple or a 401k plan, they are incentivizing these pretty well. So in years of higher income, these are good things to implement. So hopefully I kind of hit on all those topics here, Clint.
Yeah, I was just going to hit on, so the first credit's for new plans, and then that second credit with the auto enrollment can be for existing plans. So if you've had a plan open for 10 years and you did not have that auto enrollment feature, but you elect to have that auto enrollment feature added here in 2020, you get that $500 credit for this year and the next 2 years, so $1,500 total. So something to think about there.
And, you know, if you do have a simple IRA plan now and you want to go to a, you know, 401k, obviously we can defer more per employee. So you would still get that credit on the new 401k, even if you have an existing simple for your business.
Right. All right, so hit on some of the top issues for small businesses this year. Probably the biggest thing on the forefront of everybody's minds, or at least ours with tax planning going on, is PPP forgiveness, and then whether that's taxable or not. So we have a lot of clients right now that have either applied or will be applying for, excuse me, the PPP forgiveness. The original intent of the CARES Act, as you may recall, was that was supposed to be tax-free income, no different than the individual stimulus payments that were sent out. However, our good friends at the IRS decided to come out and issue a notice saying, yeah, it's true that forgiveness of debt's tax-free. However, the deductions used to get that forgiveness are not going to be deductible. So primarily in this case, the payroll would not be deductible and therefore not really making it tax-free as the intent. So we're hoping at some point here in the near future to get clarification on this. The likely scenario is that this will get added to round 4 of the stimulus. That's been in discussions for quite a while right now in Congress. It's been on multiple bills or drafts of the bill. So we're hopeful that it gets included in the final version of the bill that gets passed, if it gets passed. But it sounds like there's a good likelihood it will here in the lame duck session. So hopefully more to come there. Right now, with our tax planning, we're assuming that it's going to be taxable. So if we need to make any last minute adjustments, we'll need to do that. But for now, we're being conservative and just assuming it's taxable. And then as you recall, and we've hit on this pretty hard the last couple of years with the new Section 199A deduction for net business income is a 20% deduction. So just be cognizant of that, and we've been working through that. We still have the low corporate tax rate, 21%. Just a reminder, R&D credits, we've been taking a pretty hard look at that with some of our clients. If you do anything as far as generating new products or efficiencies with current products, and you got a team that's working on those designs, prototypes, you name it, there's R&D credits out there both on the federal and state level. So if you have any questions on whether you might have any expenses that meet those qualifications, just let us know. Always think about employing your children, if you can, either on the farm or in your rental business or other business. One nice thing is with the kids, if they're under the age of 17, you get out of having to pay FICA on them, which is great. The second really great advantage is with the standard deduction doubling, with this new tax law that we've had in effect the last couple of years that Andrew hit on. For one of your kids, their standard deduction is $12,000, so you could pay them up to that amount, and it would be tax-free income to them, which is great. Of course, it's a deduction for your business. On top of that, it really presents an awesome opportunity to have your kid put that money into retirement right away into a Roth IRA, so then that money ends up being tax-free for life, and that growth can be a huge deal for a young kid. So something to really take a look at. And then the last thing, just as a reminder before I get to the end here, if you go to our website, there is, I'm going to try to pull open here. If you go to our website and go down to the bottom here, there's the 2020 tax planning letter. So a lot of the stuff that we're going over here today, and there's some other stuff in there. Take a look at it, read through it, and if you have any questions, don't hesitate to reach out to us or ask, but just want to make sure you guys are aware that we have that out there.
We had a comment come in. So, as part of the CARES Act, they, this is kind of back to the retirement planning. So, with RMDs going away for 2020, we could potentially, if you think rates will go up, you could still take your 2020 RMD. And, if we expect rates to be up in the future, if we can do the RMD, make it taxable in 2020, obviously it's less that we'd have to take in future years.
Right.
So I'll kind of keep looking at these as you go.
Perfect. All right, so as we recall, there's, like I said, we're nearing round 4 of the stimulus legislation. So just to hit on the 3 that we currently have, when COVID first really rolled out, the first thing that came out was the Families First Coronavirus Act, and I'll hit on the key items that came out of that. And then we had the CARES Act, which was the biggest package passed thus far, and there was a lot that came with that, and we'll hit on some of those key items here in just a bit. And then maybe a lesser known one, round 3 was really the Payroll Protect, or the PPP Act of 2020, and they call it the Flex Act because it added some flexibility to that with the PPP loans that were currently out there already. And I'll hit on some of those key changes. It's kind of a refresher. And then, like I said, round 4 is kind of sitting out there pending. So the AICPA has a list of recommendations, which we'll go through here in just a bit. So with the Family First Act, the two biggest things that came out of that was a tax credit for emergency paid family leave and then also sick leave. Right now, it feels like here in the Midwest, particularly in our area, it's really starting to hit us harder now than what it has in the past, especially when you look at the East or the West Coast or the South. So this is really coming up a lot more frequently now with people needing to quarantine, employees needing to leave work to be home because they're quarantined, or they have a kid that needs quarantine, so they got to stay home because they don't have any way to provide childcare, or let's say the child care facility has to close down because of issues. So with that, a lot of people are going to be hitting on that sick leave or needing to take the paid family leave. So just a reminder on those things, we do have a chart out on our website that lists all the different qualifications for each and how that works. There's payroll tax credits that come with those. So just let us know if you're running into that. If you have any questions, let us know. But then we also have that chart that's in our blog section on our website. So please take a look at that if you have any questions. And then with the CARES Act, a couple of the major items that came from that was employee retention credit, payroll tax deferral. So on the employer side, you're able to defer that payroll tax for the rest of the year. Then you got to pay 50% of it back by the end of 2021, and then the other 50% of it back by the end of 2022. So it's not a forgiveness, but a deferral of having to pay in that FICA tax. And then the payroll protection program, which we've hit on numerous times. We'll kind of hit a couple highlights there. The EIDL disaster loans came out as well. And then we did see quite a few here in Nebraska with the small business stabilization grants and different programs that came out of the state as well. So as I mentioned, the AICPAs kind of came up with a list of stuff that they would like to see happen here in this round 4 of stimulus. The biggest thing is the full deduction for PPP related business expenses. So they're again, like we talked about, making that fully tax-free income on the PPP forgiveness. They want to provide simplification to the loan forgiveness process. Luckily here, about 3 or 4 weeks ago, we did get a simplified form. So anybody that has less than $50,000 in PPP funds or loan, there's a simplified 1-page form. It doesn't require any computations. It's just initialing that you use the funds as intended and signing off. So it's a pretty simplified form. We're hoping it was going to be for 150,000 and less, but we at least got 50,000 less now with that simplified form. They want to develop a uniform remote working process and procedure. As we know, we have a lot more folks working from home. Might not impact us here a lot in Norfolk, but if you have an employee that, let's say if you had a business in Omaha and your employee is in Council Bluffs in Iowa, now that they're working from home every day, does that income need to get sourced from a state tax perspective to Iowa, because that's where the employee is working. So it's causing a lot of issues with cross-state work, especially with remote workers. So if you have any issues with that, just let us know. We can help you through that. Allowing 501c6 organizations access PPP. So like the Norfolk Chamber here wasn't able to access the PPP, so they're looking at opening it up to some of those organizations. Provide relief to state and local governments, and then adopt new COVID-related liability provisions. And that is primarily aimed at businesses to help with liability protection when opening back up. If, there could be cases where you get COVID in the office. So it's just trying to help those businesses feel a little bit more confident in being able to open and fully engage in their business. All right, so we're going to spend some time here hitting on the CARES Act and the major changes that came with individuals. As you remember, the stimulus package included the individual rebates, is what they call them, that came out to individuals. It was up to $1,200 per individual plus $500 for a dependent. So that was one of the biggest things there. The retirement plan distributions, the penalty was waived for 2020 if you're impacted by COVID. So if you needed to take a distribution out of your 401k early before retirement age or your IRAs, you could do so. There's different provisions that if you would like, you can pay it back over a 3-year time frame. But in that tax due, you still got to, it's waiver of the penalty, and that's at 10% penalty, but you still got to pay tax on the distribution itself at your normal tax rates. And with that, you can string that out over 3 years if you needed to. So just FYI there, but we've been telling a lot of folks, especially now with the market bouncing back as it has, it's a good thing that they kept the money in their retirement accounts to let it grow back to where it is now. The RMD requirement waived for 2020, Andrew kind of hit on that here just a little bit ago. Even though it's waived, depending on your tax situation and the lower tax rates, it still might make sense to do that RMD for 2020. $300 above the line charitable deduction. So what happened when the standard deduction ended up doubling, it really disincentivized a lot of folks potentially to do giving at all. So there was a need for that and a call, especially from charitable organizations, that they'd like to have something that still incentivize folks from a tax perspective to still continue to give. So one of the things they did was added this into the CARES Act. So you got your normal standard deduction, this $300 for cash donations, it's cash donations only, can get added on top of your standard deduction here, 2020. So if you have any of those, make sure you bring those receipts into us and we can make sure we get those added on top of your standard deduction. If you itemize, it's the same as you've done before. They've also increased the limits on charitable contributions in general. So if you're getting limited due to your AGI being too low, they've now increased those limits so you can get more of a deduction with your charitable giving if you itemize. And then we have a few folks that have been taking advantage of this. Student loan repayments from employers to employees up to $5,250. It's a deduction for the employer and it's tax-free income to employees. So that's making payments straight to those employees' student loans. It's been a pretty nice benefit there for a few folks that have utilized that.
And I know one thing on that stimulus rebate. So when we do go to do tax returns and you did receive a stimulus check or the direct deposit, your tax preparer will need to know, what you received. And we got word that, they sent out a little letter once you receive the payment a couple weeks after. So we just need to know, what the family received so we can reconcile that stimulus on the 2020 tax return. So if you don't have that letter anymore, you pitched it, we just need to know what you received. So whether you go back on your bank statement and see what you received from the Treasury Department, we would need to know that.
You got ahead of me there, Andrew. So yeah, this is that notice 1444 that's, no, you're good.
Yep.
Yeah, this is a notice that you should have received after receiving your economic stimulus payment. So if you have that, great. If not, we will need to know the amount. And really the primary issue there is, one, just know that it's not taxable income. So it's not going to get added on to your tax bill. You're not going to have a tax liability due to receiving the individual stimulus. It's really treated as an advanced credit on your 2020 tax return. So it's just a plain credit. It's not taxable income. But the important reason why we need to know the amount is if you got less than $1,200, it could increase your credit on your tax return. You could get additional refund back if you were shortchanged. So say if your income was high on the 2019 return that you filed, but your 2020 return is lower just because of what happened with COVID and you show lower taxable income, you could end up getting the full $1,200 rebate versus maybe you only got half of it or 75% of it. And then the second thing, probably the more common thing we will see is if you have a new dependent born in 2020. So anybody that had a kid that was born in 2020, that would get you an extra $500 credit on your tax return. So you can increase your refund by that amount or decrease your tax liability by that amount. So just be important that we know exactly how much you got, because we'll have to reconcile that on your return. If we don't get the right numbers in there, we'll probably get an IRS notice and then it just kind of drags out your tax return. So we want to avoid that as much as possible. All right, on the business side, the key changes here, one of the biggest things was with the NOLs. They temporarily repealed the taxable income limitation. So with the Tax Cuts and Jobs Act, one of the things it did with NOL carry forwards is that it limited you to only use up to 80% of it to offset taxable income in any given year. So let's say, for instance, you had a $100,000 NOL coming forward in 2020, and you had 100,000 income. And normally you would think, well, I can offset that income and get to zero and don't owe anything. Well, under the Tax Cuts and Jobs Act, you can only utilize 80,000 at NOL, so you still had to pay taxes on that 20,000 net of income that you're left with. Well, this CARES Act noticed that people are going to need to utilize those NOLs to help with cash flow due to COVID, so they repealed that temporarily for a couple of years. So now you can fully offset income without that limitation. And then another nice thing it did, the Tax Cuts and Jobs Act did away with carrybacks of NOLs besides farmers. Well, they brought that back for everybody, so that carryback is now allowed again. So if you're in need of cash and help with cash flow, that's one of the things we've been looking at with clients is carrying back those NOLs to get some tax refunds and free up some more cash. The next thing, which is a really nice deal, with the previous act, they've missed some language that didn't allow certain property to be treated as 15-year property, and so it ended up getting treated as 39-year property. And we call that QIP, or qualified improvement property. So with that, with the correction, now considering it 15-year property, you can now bonus that again, as we could before. So that's been a huge, nice change here to some folks. So that was key. We talked about student loan repayments. So that's been nice for some businesses to offer that to the employees. And then of course the PPP, which we're going to hit on that here. All right, I think we've hit on the PPP a lot over previous webinars. One of the things I just want to spend a little bit of time on here too is hitting on the Flexibility Act that kind of came out there in the first part of June. So as you may recall, it increased the time frame to look at allowable expenses from 8 weeks to 24 weeks, but no longer than the end of the year. And then another key tweak that it made, so if you have any PPP loan left over because you don't get full forgiveness, originally it was a 2-year loan at that 1%. Now it's a 5-year loan at that 1%. So if you do need to carry that loan, you get to carry it out a little bit longer, which is nice. Another key change made, it reduced the 75% requirement of payroll down to 60. So basically before, it required you to have at least 75% of the allowable expenses for forgiveness to be from payroll. Now it's only 60. So I think that was a nice little change there. There's some exceptions that added with regards to employees. So if you had some employees that left on their own terms for whatever reason, you didn't have to count that as a headcount reduction. So that was a huge help there. And then one of the bigger things too that may have been overlooked, and we've helped a few folks with this, originally you could not double dip with both getting the PPP and utilizing that payroll tax deferral. They changed that with the Flexibility Act, so you can still do both. So if you weren't doing the payroll tax deferral before because you got that PPP and it could help you utilizing it to free up some cash, it's definitely something to take a look at. And then taxpayers have up to 10 months from the date that the funds are dispersed to apply for forgiveness.
You kind of see the trend there with PPP. They're really trying to make sure people have this forgiven 100%. So that's kind of where it's trending. So hopefully the next round of PPP kind of takes that into account on the front end instead of the back end.
Yeah. And then there's a few things to hit here. One of the things, the portal has been open for quite a while for the SBA to receive those forgiveness applications, but they're kind of sitting on them for a while. But now it sounds like they've been processing those and loans have been forgiven. So, if you're in a position that you can get the forgiveness done, now might be a good time to work with your banker and get that going. All right, these next couple items we're just going to quickly hit on. With the Tax Cuts and Jobs Act, they did some tweaks to the business entertainment expenses, or meals and entertainment, which we commonly refer to them as. There were some open items for interpretation, let's just say, and so that they sought clarification from the IRS on those rules. The IRS finally came out with final regulations concerning the meals and entertainment deductions. What happened with the Tax Cuts and Jobs Act, it completely took entertainment out and saying it was 100% not deductible. So then there was a lot of questions if, let's say, you took a client out for a concert, but you had a meal before that. Was the meal still 50% deductible, even though the entertainment, the concert tickets are 100% not deductible? Well, we finally got clarification that yes, that is the case. The key thing here is make sure you keep your receipts. And if there's entertainment in the mix, make sure you bifurcate the two so you can still get 50% deductibility on the meals portion, and then the 100% non-deductibility on the entertainment. It's a good time to just make sure your trial balance accounts and separate those things out so it's easy for us to identify, so we make sure you still get as many deductions as possible. We're not taking too many deductions or not too little deductions, so just be mindful of that. And of course, your normal holiday parties for your employees internally, all that stuff's still 100% deductible. Anything related to employee engagement does not fall under this umbrella.
We did have a question come in on PPP and the EIDL grant. So yeah, those EIDL grants, all these programs kind of run together a little bit. So the EIDL grant was in advance. So that was the online process that he did. It was fairly quick, 15, 20 minutes, and you could get in advance for $1,000 per employee. So how does that relate to the SBA, the PPP loan? So a quick example, that EIDL grant is an advance on your PPP loan. So if you got a PPP loan of $50,000 and you got a grant of $10,000, basically the $50,000 will be forgiven, and you'll still have that $10,000 amount payable back to the bank as a loan. Hopefully I said that right. So the PPP, 40,000 of your PPP in summary will get forgiven, and you still owe 10 back to the bank. So
right.
that EIDL grant, $1,000 per employee, is just an advance on your PPP loan. So whatever you got in those grants is basically, if everything's forgiven, that's what you'll owe back to the bank.
Right. And to clarify too on the EIDL, it's our understanding that those EIDL loans are going to be, or the EIDL grants are going to be taxable as well, even though it initially sounded like they were supposed to be tax-free. But hopefully we get clarification along with that and the PPP together when that all comes through on this next round of stimulus. Thanks for the question, Mike. I hope you're doing well, by the way. All right, just one minor change here that's new this year. There's a new form called a 1099 NEC for non-employee compensation. In the past, non-employee compensation was in box 7 of the 1099 miscellaneous. So now there's a whole new 1099 form just for non-employee compensation. So this is the first year for it. So we just want to throw that out there for anybody that does their own 1099s to make sure that you get that done on the right, correct form for non-employee compensation. So change there. All right, I'm just going to quickly hit on this. It's been pretty much a gridlock here for a while, and especially with the election that's been, just happened here. This has been kind of put to the side, and it's just coming forward again. And I think there's some talk starting again on this because it's something that a lot of people think need to get done here soon and before the end of the year. So just to give you a quick overview of where we stand with the White House. They started with quite a bit lower number, and they've kind of worked their way up to offering up to 1.8 trillion in their plan. The House's plan, I think initially was about 3.5 trillion, and they've kind of negotiated down to 2.2 trillion. So now it's $400 billion difference between the two. The major things they don't agree on, one of the big sticking points is the state and local government. The White House only wants to give 250 billion there versus the House bill there in parentheses is 436 billion. The federal unemployment extension, White House wants just the 400, the House wants 600, and then the White House is really looking hard to make sure that those liability protections for businesses get included. And then the House really wants some additional tax credits for low-income taxpayers. So those are really the main sticking points there. But I want to hit on the stuff that they really agree upon that we hope to see. $1,200 individual stimulus checks plus the $500 for the dependents. It sounds like both sides really agree on that. So that's likely going to be in the final package. There's going to be more PPP, round 2 of the PPP, and this may be more targeted than the last time. There may be requirements that you prove that you have seen at least a 25% or more reduction in gross revenues during the time frame of COVID, or it might just be strictly targeted to the hardest hit industries such as restaurants and airlines. So more to come there on how they would structure that PPP, but I'm guessing it's going to be more targeted than before. Looking at student loan relief, rental and mortgage assistance, aid for farmers, and then a tranche of money going to COVID testing and tracing. So I think that's it. Hopefully we've really hit on everything that's out there. It's been, like I said, it's been a lot of the same with the current tax law, the Tax Cuts and Jobs Act, but yet we've had a ton of changes with everything going on this year with the stimulus packages and tweaking different things here and there. So we thought it'd just be, like I said, helpful to have this, to go over some of those key changes and then see what kind of questions you guys might have.
A couple of things I had written down. So if you were, we have the SBA programs, then we have state of Nebraska grant programs. So our stance, I think this is widespread. So the state of Nebraska was a $12,000 grant. If you receive that, it is taxable in 2020. So that's one other thing to kind of keep in mind if that's, on your income statement. And then also, I know, some of the programs from Department of Health and Human Services, if you're in that medical field, they had, round 1 and 2 was pretty much, apply and see what you get. I know round 3, they do put stipulations that you have to have, I believe it's revenue 20% lower than your last year. So they do make you prove some of that revenue loss in 2020 to get these additional rounds. So be a good reminder just to keep your books and records up to date, just because some of those applications are going to have you, submit your profit and loss in your balance sheet along with, just to get some of that free money, not free money. So.
All right, well, I don't see any more questions popping through. Just an FYI, we did record this, so we're going to get this put out there on our website. So in case you know of anybody that couldn't make it, you can let them know that, and we'll send out an email reminder when it's out there and available for everybody to view the recording. So once again, I hope everybody has a great Friday, great weekend coming up here, and stay healthy. Take care.
Yep. We were told it's Friday the 13th, so hopefully you have good luck the rest of the day here. So hopefully we got through that.
All right, take care, everybody.
Thank you.